Journalizing and posting financial transactions. So as part of the accounting cycle, we are recording information about accounting transactions in our records. So the first thing that we do is we look at the source documents that we have. Examples are receipts, then invoices, sales information. We record that into our accounting records. We look at our receipts, we identify what kind of account that impacts, we record the journal entry, and then we post that entry to our ledger or our T account. When we journal a transaction, we write it in a journal. It's called a general journal. And we are going to start with the account that is being debited. So that account gets listed first. Then the account that gets credited is listed second and it is indented. Then we have the amount of the debit and the credit, a note about what the transaction is for. What this note does to help us, it gives us a reference information so that if we have a mistake that we need to go back and find later, it makes it easier to find that information, references to documents and things like that. We're going to look at some of the different information for finding mistakes in a little bit when we talk about trial balances. Once we have our journal entries, then we're going to post those to our general ledger or our T accounts. And we're going to record a debit or credit. Then we have these reference numbers, and that is also to help us find the information related to that account and to identify that it was put into the correct account. Again, this is to help us when we find mistakes later. Currently, with computer software and accounting software, all of this actually happens seamlessly when we put information in. If you have accounting software set up, anytime you produce a sale, the entry happens automatically. We do it by hand a lot in Principles of Accounting classes to get the practice of it down in an effort to learn what is happening. Knowing what is happening in the accounting records also helps us find mistakes later, because computers do make mistakes and humans make mistakes when they are inputting things into computers. Okay. Once we get to the end of an accounting period, we create what is called a trial balance. So we have 3 steps for a trial balance. First, we list every single account that we have, and then we list the balance in all of those accounts by is it a debit balance or a credit balance. We add up all of the debits plus the credits, and then we verify that the total debit equals total credits. So that is another rule in accounting. Much like assets also always equal liabilities plus equity, debits always equal credits. They have to equal each other in order for accounting records to be complete and balanced. This is an example of a trial balance. We list everything in order, starting with assets and cash. We list the balance in each account. Even you can see that we have a 0 balance here. And then we add up the total debits and credits. If the total debits and credits do not match, then something is wrong and we have to find it and fix it. Okay, we have to find errors. So there are various ways that we can find an error. First, we want to make sure the addition was done correctly. Make sure everything was added correctly. We didn't miss a number. Okay. Then we want to make sure that the account balances were correctly entered from the ledger. We didn't accidentally write a number wrong. Okay. Then we're going to see if the debit or credit accounts are mistakenly placed. For example, was it supposed to be in the debit column or we wrote it in the credit column? Okay. Next, we go through every single one of our accounts and make sure that all of the information in there was correct. You can see that if we can't find the mistake early, that it becomes having to go through every single transaction of that accounting period separately, trying to find our individual mistake. Now, there are a couple of shortcuts to help us find mistakes, little tricks that we can use. One is you can divide the difference by 9. If it equally divides by 9, this means we're looking for a transposition error. A transposition error is when we wrote numbers in the wrong number order. So instead of writing 123, we wrote 132. Okay. If we divide it by 2, this can help tell us if a debit or a credit was entered incorrectly. So if it equally divides by 2, and you can see these things won't happen at the same time, just math rules. If it equally divides by 9, it won't equally divide by 2, and vice versa. So try both of these first. They're the quickest way to find errors. Then if you divide the difference by 2, say you're off by $1,000, you divide it by 2, the $500. So the transaction that you need to fix is $500. Whether you wrote $500 in a debit column that was supposed to be in a credit, or you entered an amount wrong in a journal entry or in a post. But that helps at least give you a number that you're looking for, that it was a $500 amount that you need to fix. After we have completed our trial balance and verified that debits equal credits, so our accounts are in balance, we do adjusting entries. So adjusting entries are required for accrual-based accounting. This is when we need to make sure that our expenses match our revenues. So there are some things that don't happen during the month until you record them in an adjusting entry. One is prepaid expenses. For that example, when we paid 2 years of insurance on one date. So we paid $2,400 for 2 years of insurance. So every single month we need to record $100 insurance expense and reduce the amount of that prepaid insurance. So that is called a deferred expense. We paid for it already, but we use that benefit every single month in our insurance. Another adjusting entry is depreciation. So depreciation is how we reduce or allocate an asset across its useful life. For example, a computer. Computers have a useful life of 3 to 5 years. So this is actually the IRS tax code recommended useful life. Companies can set their own useful life, but they generally go within the IRS's standards. So they would choose either 3 years, 4 years, or 5 years, and this would indicate when they're going to have a replacement cycle. So say a computer is going to last for 5 years, that's our company policy, then we are going to spread the cost of that computer over a 5-year period using a method called depreciation. For depreciation, we're going to be looking at straight line depreciation in this class. There are multiple other methods. We're only going to use straight line in this class. You will learn other methods in financial accounting, and if you are an accounting major, as you move forward, you're going to learn and use multiple methods of depreciation. But we're going to be looking just at straight line depreciation in this class. So straight line depreciation is the cost of the asset minus any salvage value, or sometimes called residual value, divided by its useful life. So for example, if we had a computer that we paid $1,000 for, that had a salvage value of 0, which means at the end of its useful life, it's not worth anything. We're not going to get any money by trading it in. and it has a useful life of 5 years, we would take 1,000 minus 0 divided by 5 to get our yearly depreciation expense. Unearned revenue is an adjusting entry. So unearned revenue is when a customer pays us cash up front and then we owe them a product or a service. A good example of deferred revenue is a subscription service. So say you have Amazon Prime and you pay one time a year the $120 a year. Amazon owes you for 12 months of Prime, even though you paid them once. So that's unearned revenue to them, and they have to recognize the 1 month of that revenue every month when the revenue passes. An accrued expense, which is an expense that is unpaid or won't be paid in that accounting period. For example, one good example of an accrued expense is payroll. Say the year ends on the 31st and you pay your employees on the 1st of every month. So you have to close your accounting records on the 31st, but you're not going to pay them until the 1st. So you're going to accrue that payroll expense and record it in your books in recognition that you're going to be paying it at a future period. You owe them the wages that they've earned through the end of the month, even though you aren't going to pay them those wages until the beginning of the next month. This slide is another one of those really nice reference slides where you might want to print yourself this or take a screenshot of it and save it somewhere just to have it as a reminder when you're doing accounting transactions and when you're doing adjusting entries to help you remember how they impact your accounting records. Once your adjusting entries are complete and you've created an adjusting trial balance, you can prepare your financial statements. Financial statements are prepared in a very specific order. So we've already talked about financial statements, the types of financial statements we make, and knowing that people are using our financial statements for various informations to see how our company is performing, to look at results from year to year, to compare our results across competitors. The last chapter we look at this semester is called Financial Statement Analysis, where we're going to look a lot at this assessment of company results using the financial statements to analyze. Our 3 primary financial statements are the statement of financial position, also called a balance sheet, our income statement, and the statement of cash flows. We've talked about these each a little bit already. So we have our balance sheet, which is the business as a specific date, and it shows our accounting equation. We have this example of a balance sheet right here where our assets equal our total liabilities and equity. The income statement is the revenues and expenses for the accounting period, and the net income, which is the difference between our revenues and our expenses. And then the statement of cash flows, which shows how we used cash during an accounting period. That often gets separated into our daily operating activities, our investing activities, and our financing activities. It explains how cash has changed from the beginning of the accounting period to the end of the accounting period. Okay. We start with an adjusted trial balance, where after our adjusting entries, we list everything in our trial balance, and then we prepare the income statement. The income statement is always prepared first because we need information from the income statement to prepare the other financial statements. So you prepare the income statement first. Then we prepare the statement of retained earnings, which shows us how retained earnings has changed from the beginning of the period to the end of the period with the addition of net income. Then we prepare a balance sheet, and then the statement of cash flows. We will be looking at some of these examples. We will not be preparing a statement of cash flows in this class. You will do that in financial accounting. We focus mainly on the income statement in this class, but we will be looking at some of the other financial statements a little bit too. And then we're going to discuss closing entries and ending our accounting period in the next video.